Hello, my name is George, and in this video, we're going to talk about the best debt consolidation loans for bad credit. If you're juggling multiple debts and struggling to keep up, a consolidation loan could help you simplify payments and maybe even save some money. But if your credit score isn't great, finding the right loan can be tricky. So today, we're breaking down some of the best options, looking at their rates, fees, and what makes them stand out. By the end of this video, you'll have a clear idea of which loan might be the best fit for you. And by the way, all the companies that I'm going to mention in this video, you will be able to find by clicking the first link down in the description of this video. And before we dive in, a quick note, some links in the description are affiliate links, which means I may earn a small commission if you make a purchase through them at no extra cost to you. Thank you so much for supporting my channel, and now let's get started. What is debt consolidation and why should you consider it? Let's start with the basics. Debt consolidation means taking multiple debts like credit cards, medical bills, or personal loans and rolling them into one new loan with a fixed interest rate and a single monthly payment. The idea is to make your debt more manageable, and if you get a lower interest rate, maybe save you some money in the long run. But here's the thing, if you have bad credit, meaning a credit score below 670, getting approved for a good debt consolidation loan isn't always easy. Lenders prefer borrowers with higher scores because they seem less risky. But the good news, some lenders specifically offer loans to people with lower credit scores. The key is knowing where to look and understanding the costs that come with these loans. Can you get a debt consolidation loan with bad credit? Yes, but it's not always simple. If your credit score is on the lower side, you'll probably face higher interest rates and extra fees. That's why it's important to compare your options before making a decision. You don't want to end up with a loan that costs you more than the debt you're already struggling with. A few things to keep in mind when looking for a loan. Check the annual percentage rate, also called APR, which includes the interest rate and any fees. Some loans also have origination fees, which are upfront costs the lender takes out of the loan before giving you the money. And of course, you'll want to look at the repayment terms, how long you'll be making payments, and how much you'll owe each month. To help you find a solid solution, we've compared some of the best debt consolidation loans for bad credit based on their approval requirements, interest rates, and fees. And here's what we found. Which lenders offer the best debt consolidation loans for bad credit? Achieve, ideal for low origination costs. Achieve is a strong option if your credit isn't perfect. They offer flexible loan terms, fast approval, and decent interest rates compared to some other lenders. The lowest APR they offer is 8.99%, but it can go as high as 35.99%, depending on your credit score. You can borrow anywhere from $5,000 to $50,000, and you'll need a credit score of at least 620 to qualify. One thing to watch out for is their origination fee, which ranges from 0.99 to 6.99%. A big plus with Achieve is that they let you check your eligibility with a soft credit check, meaning it won't affect your credit score. If you're approved, you can get your money in 24 to 72 hours. Upstart, best for limited or no credit history. If you don't have much of a credit history, Upstart might be your best bet. Unlike other lenders that focus mainly on credit scores, Upstart also look at things like your job history and education when deciding if you qualify. Their APR starts at 7.8% and goes up to 35.99%. You can borrow as little as $1,000 or as much as $50,000. What's unique about Upstart is that they'll accept borrowers with credit scores as low as 300 or even no credit score at all. One thing to be aware of is their origination fees, which can go as high as 12% of the loan amount. That means if you borrow $10,000, you might only get $8,800 after fees. But the good news, they process funds quickly. Most people get their money the next business day. Upgrade, top choice for flexible payment plans. If you need a loan with flexible repayment terms, Upgrade is worth considering. They let you choose loan terms from 24 months to 84 months, which gives you more control over your monthly payments. Their APR ranges from 7.99% to 35.99%, and you can borrow between $1,000 and $50,000. The minimum credit score required is 600, so they're a bit more lenient than some other lenders. One great thing about Upgrade, they offer tools to help you manage your credit. You get access to a credit score simulator and weekly credit updates, which can help you track your progress. A lending point, fastest approval, and funding. If speed is your top priority, Lending Point is a solid choice. They offer same-day approvals and funding as soon as the next business day. Their APR ranges from 7.99% to 35.99%, and you can borrow between $1,000 and $36,500. To qualify, you need a credit score of at least 620, and you also need to make at least $35,000 per year. The downside, their origination fees can be as high as 10%, and they don't offer loans in Nevada or West Virginia. But if you meet the requirements and need cash fast, they're one of the quickest options out there. Avant, great for minimizing upfront fees. If you want to keep upfront costs low, Avant is a great pick. Their origination fee is lower than most competitors, which can save you money if you're borrowing a large amount. Their APR starts at 9.95% and goes up to 35.99%. You can borrow between $2,000 and $35,000, and you need a credit score in the poor to fair range to qualify. Now, one big advantage with Avant is that if you're approved by 4:30 p.m. Central Time, you can get your money the next business day. They also offer a 10-day grace period for late payments, which can be helpful if you need a little extra time. Are there any downsides to debt consolidation? While consolidating debt can help simplify your payments, it's not always the best move. Sometimes the interest rate on a new loan might actually be higher than what you're currently paying, especially if you have bad credit. Another thing to consider is the fees. Many lenders charge an origination fee, and if you're not careful, those costs can add up quickly. Plus, there's the risk of falling into the same spending habits once you consolidate your debt. Just because you have one payment instead of several doesn't mean the debt is gone. You still have to pay it off. What are your other options? If a debt consolidation loan doesn't seem like the best fit, you might want to look into other options. Some people try negotiating directly with their creditors to lower their interest rates or create a new payment plan. Others look into credit counseling, where a financial expert can help create a debt management plan. There's also debt settlement, where a company negotiates with your creditors to reduce the amount you owe. But be careful, this can hurt your credit score and even lead to lawsuits in some cases. Final thoughts. Overall, debt consolidation can be a good tool, but it's important to make sure it actually saves you money. Before taking out a loan, compare the interest rates, fees, and repayment terms to see if it's really worth it. And remember, if you're looking to consolidate your debt, check out the first link down in the description of this video. I hope this video was helpful. Thank you so much for watching. Till next time.